It's our in-house view segment right here on ET Now, where we visit the top brokerage houses and, of course, get you insights of some of the top minds in the world of financial investments. So All right, so let's introduce then our special guest. We've got Neeraj Gambhir, Managing Director and Head Fixed Income India at Nomura Capital, who now joins in on the show. Neeraj, great to have you with us. To start off with, lots of options for credit policy that the RBI governor has at hand, but it seems to be a unanimous 25 basis points repo rate hike that everyone seems to be concurring with. Would you too be expecting the same?
Yeah, I think that's the base case. The base case is that they will increase the repo rate by 25 basis points, but also simultaneously reduce the MSF rate by 25 basis points. And I think there is some expectation in the market that they'll probably increase the amount of liquidity that will be available through the LAF window, which is either in the form of overnight LAF or term repo, so that the operational rate for the markets becomes LAF or closer to LAF rate. So I think that's the key expectation or the baseline expectation currently from the policy.
In terms of the bond yields, they have been fairly range-bound of late. Do you think that if the RBI does go ahead with the 25 basis points, that we will continue to see 8.5 to 8.7% for the bond yields continuing?
Yeah, I think so. I think the expectation of a 25 basis point repo rate hike and a 25 basis point MSF cut is something which is there in the price today, and that's the baseline expectation that the market has, and we should sort of continue to trade around the current range if this is what eventually happens in the policy. However, if the policy does end up surprising either in the positive or negative sides, then the bond market will take a cue from that. Also bear in mind that October was a relatively lighter month in terms of the government bond auctions, and the month of November is pretty heavy in terms of supply, so the market will have to contend with that supply as well. So there could be a little bit of an upward bias on the yields, as even if we get 25 basis point as expected on the policy.
Going forward then, what do you think will be the view for the rupee and the currency as to how it's likely to trend?
So I think currency is also becoming fairly range-bound. Some of the factors which were weighing down quite a lot on the currency, which is basically very high current account deficit, the liquidity reversal on account of Fed tapering, those factors have actually kind of receded. We've seen a lot of uncertainty around the timing of the Fed tapering, whether it is going to be the first quarter of next calendar year or even after that. And also we've seen a reasonable improvement in the current account dynamics, in the latest current account data. So I think both of these factors are also kind of weighing quite largely on the currency. There is a very significant flow that has come in by way of FCNRB deposits, and that's been absorbed by Reserve Bank. I think the important factor for the currency market or rupee is that when the oil marketing companies will be allowed to buy into the market, into the open market, and that could decide the next sort of move in the currency. If the demand of oil marketing companies comes back into the market, we could see a little bit of upward bias, in terms of rupee dollar rate coming into the market.
Neeraj, if we look at the kind of evolvement that we've had in the RBI policy since May 2013, when the external headwinds, concerns over QE were far more severe, things have significantly improved since then. Do you still think that in light of this, the focus of the RBI will continue to be on the liquidity situation as well as the inflation?
I think the focus will steadily now shift towards more inflation than liquidity management. I think clearly those were extraordinary circumstances when the monetary policy was more being used to manage the external sector impact on the economy. The sharp increase in the overnight interest rates and the resultant sort of spike in the yields was being used to address the pressure on the currency. As we have seen currency come back into the stable regime, we should see some of, we've already seen some of those measures getting unwound, but we should see a complete reversal of those measures over the next few months. And as that happens, the policy stance and policy view will start, addressing the growth and the inflation trade-off that we are currently facing in the economy. I think initially it does look like the Reserve Bank is quite concerned about the rise in the inflation rate, both in the WPI as well as in CPI. So we could see some measures, some tightening measures over a period of time to address that.